The next topic is rollover. Rollover is interest paid or earned for holding a position overnight. Each currency has an interest rate associated with it, and because Forex is traded in pairs, every trade involves not only two different currencies, but also there are two different interest rates. If the interest rate on the currency you bought is higher than that on the currency you sold, then you will earn rollover. If the interest rate on the currency you bought is lower than that on the currency you sold, then you will pay rollover. Rollover can add a significant extra cost or profit to your trade. It is worth noting that rollover is applied to your trading account at the close of the New York session, which is 10 PM GMT. So if you want to avoid rollover charges, ensure that your open trades are closed before 10 PM GMT comes around. Personally, I'm usually asleep or just waking up, so I don't tend to worry about rollover charges. Rollover credits or debits are shown on your account statement. Rollover can often be referred to as swap. In this example, we can see a rollover or swap debit for a trade on the Australian dollar to the US dollar.